War, oil, and multifamily, with the price of oil spiking. Now it's coming down in fears of potential recession and still a looming wall of loan maturities circling the multifamily industry. Yet at the same time, investors are optimistic, having dry powder wanting to deploy in assets that seem to make sense in just an insane world that we live in. Well, on the Gray Report, we're going to try to break some of this down, try to make sense of where we are and maybe where the market is going. We don't have a crystal ball, but trying to look at some of the best information to, again, try to see which direction the wind is blowing today and try to maybe see what might be happening over the next couple days, weeks, or months. So if you're a multifamily investor, active or passive, you're in the right spot. We're breaking it all down today. Special guest host, Addison Lubert, senior analyst here at Gray Capital. He sees all kinds of deals. He talks to all the brokers. He's boots on the ground with what's going on in the multifamily market. You're going to want to stick around to hear all of the insights as we're going to be breaking down live deals, deals that we've just lost, deals that we're looking at, trying to not give away too much that we're not supposed to. It's going to be really interesting. But we're also going to talk about what this war in the Middle East, how it impacts multifamily, how it may impact the macro economy, and the opportunities to get ready for later this year that could present themselves. It's going to be a really interesting conversation. You're going to want to stick around for the whole thing. Make sure that you're subscribed to the Gray Capital YouTube channel to stay up to date. Like this video if you think it's halfway decent. Let's get into it. Welcome back to the Gray Report. Addison Lubert back on the Gray Report.
Yeah.
Welcome back, Addison. How's it going?
It's going great. Thank you for having me again.
We got some unfortunate news right before we started,
Yeah.
right before we pressed play. We lost another deal. I want to talk about that deal. I want to talk about the market, what you're seeing, what we're all seeing, what we're going after, what we're trying to do here, at Gray Capital, in addition to a full slate on our agenda today. Before we get started, for folks that are watching on YouTube or listening and they may not have caught one of your great episodes you've done in the past, which go back, watch previous or listen to previous Gray Report episodes. Addison's probably been on 5, 6 times. I don't know. You've been on a good time. A regular guest on the show.
Yeah.
To say the least.
Regular back end.
Regular fill-in. Griffin is he's on assignment right now. I think in sunny Florida. He'll be back in the seat. But Addison, when I'm never sure of like who should come on, sit in with me, and I thought about doing it by myself. That's not fun. Listeners want to know what's going on. You know what's happening like on the ground, and you are grinding away, underwriting deals, looking at deals every single day, talking to brokers, talking to lenders. There are so many people out there that just would want to pick your brain of what's going on. So this is sort of what we're going to be doing, in addition to getting your your insights into some of these other kind of multifamily and also like macro. I know you follow kind of geopolitics, you follow global events, and so you're going to be read in just as much as you need to be to connect all of this back to multifamily and see where maybe it's going to go. So before we get into the war, before we get into some of the stats, there was this piece up on the screen that it came out. It's related to a Q4 2025 survey, which just seems like years ago, not a quarter ago, but from CBRE saying core multifamily buyer sentiment improves during the fourth quarter of 2025. Again, this was released March 2nd, so it's actually a new report, but it's talking about a survey from the last quarter. Oh my gosh, so much has changed since then. What do you think about these surveys, Addison, before you tell us where you think the market's at and where your sentiment is?
I think it's helpful on kind of a broader level. You can, I guess, get a better sense of a trend as to how people are feeling. And, deals are getting done in every environment, but when they kind of track people's sentiment, especially via something like underwriting, I think it gives you a better idea of where people are at. Just because last year I can think of a few markets where it felt like a lot of deals got done, but then when you talk with brokers, you get a feel for what their equity sources were. It's like, well, going up against 1031 groups or DSTs or one of those few groups that can do something relatively large and all cash.
So deals were getting done, but we know volumes were so low last year, so not a lot of deals were getting done. So I guess just the on the surface, it looks like transactions are happening,
Right.
but they're at elevated prices because the type of buyer that's transacting, I think what you're saying, are ones that may be willing to pay a premium over folks that are trying to get like a certain return.
Right.
Like we would maybe consider market return, call it a 15 IRR over 5 years. If you've got a 1031 investor who's like, I just don't want to pay taxes, I'll make a 5% return or I'll make a 10% return. It's hard to compete because we look at a lot of if we just had to hit 10% IRR, we would be winning deals.
Yeah.
We'd be winning a lot. But that's not happening.
We'd be talking about our latest deal.
We'd be talking about our latest deals. So what are brokers saying?
I think by and large, everybody's optimistic. Now, granted, they kind of have to be, but I think everybody's optimistic for, I think kind of as we hit the summer, back half of the year, combination of loan maturities. I think some people that are at a point in their business plan where there's probably some people that might have been interested in 2023 of selling or 2024. And there's an element of, well, we'll wait it out. We'll wait for a better environment. We don't have to sell, but kind of with our hold period, that's kind of what we projected. You looked at where the interest rate environment was, probably what the buyer pool is going to be. And now in 2026, I think a lot of those groups have realized it's not getting any, I shouldn't say it's not getting any better, but rates aren't going to drop to a point that we were hoping to see. I think everybody, going on year 3 of just kind of this environment, I think sellers' expectations are willing to meet the market and getting closer.
It's we're like a Mexican standoff, buyers and sellers, interest rates.
I would say so. I also think there's a lot of people that are putting a lot of, it's not super attractive to bring something out at this period anyway. You're not in leasing season. There's
I don't know, leasing season starting earlier and earlier every year.
There's some brokers that are saying, we have stuff that we'd love to bring
They want
out.
to get through leasing season.
Right.
Because so one thing that we've seen, I know you've seen is, and we've reported on the Gray Report now for the last 6 months, but the last 6 months, many rent rolls have seen flat or negative rent growth.
Right.
Which is not what a broker, when they take out a deal to show to a buyer, they want to show they just increased rents.
Yeah.
They don't want to say they're lowering rents, because as a buyer, I say, well, if they're lowering rents, how am I expected to raise rents?
Right.
So what do they say? What are they saying?
I mean, in that situation, I think that's why a lot of them have properties that they're ready to bring out, they're ready to launch.
Yeah.
But because that's the reality, it's like, hey, let's get through April, let's get through May, let's have some, for lack of a better term, wins on the board that we can say, this is where things are moving, and it's up to you to do the rest.
And that doesn't help on a positive leverage, conversation or your acquisition cap rate, because even if your purchase price stays the same, the value stays the same, if their trailing financial statement is declining slightly, because if you have negative rent growth, you could be paying the same price for the same property, but you're buying at a lower cap rate.
Yeah.
So you're paying up more for less income. So I guess the idea is, okay, well, you're going to be able to grow back out of that. Look at where your incomes were, and that's more of your base, and grow out of it. And once you get through this, we'll see some strong rent growth. And you would say it's a basis play if it was readjusted for that decline in income, but we're not seeing that.
Not quite. And, another, I guess, pattern that's emerged is, and this is applicable probably to more older vintage properties. There's a runway where you can do work and there's a gap. But you look at where the Class A rents are, and it's like, well, there's not much of a gap. Those seem to be, for lack of a better word, underperforming. And you want to believe that there's runway and that they're all going to take off. But you start to get concerned about the business plan if you need 5 or 6 Class A properties to really run away in rent growth for you to then have something built in the 80s, 90s, or 2000s for you to feel like you can not only achieve your premiums, but also still be a good amount less than the Class A rents, that
Yeah.
people are still going to see that value. The renters are still going to see that value. So that's been kind of their early trends, early patterns, and early conversations. But on a positive note, I think we've been closer on a lot more potential acquisitions.
Why is that?
Um,
Is that brokers appropriately setting the seller expectations like a little bit closer to reality, or are we able to get a little bit closer, or is it the debt? Is it rents? Obviously, it's not the rents. Obviously, they've been flat or negative.
yeah, I mean, I would say, there's been some special circumstances. I think of the two that we've been close on recently, they fit that pattern of, they do have a loan maturity, and not in a bad way. It's just they're at a spot where they've achieved what they want to achieve, and they would have to go through a refinance. And if they're going to go through a capital event, they'd much rather go through a sale than a refinance. And so you're in a situation where, as they always say, I guess, pricing is, or market is going to determine the pricing, but they have to go. This
Yeah.
isn't they're not in a spot where they don't like it and they can pull it off.
The last two deals we've gone after have had loan maturities coming up.
Yep.
But long term, yeah, all like permanent. They weren't bridge loans. They
Right.
just happened to have been originated, and they all happen to be maturing.
Yeah.
Over the next, call it 6 months or so.
Yes.
Do you find that that the data shows that are a lot of maturities coming up? Are you seeing, are those outliers? Or are you seeing that narrative more of like, hey, they've got a maturity coming up. It's always, they don't need to sell. They could refinance it, but they'd prefer to sell. They're in a really good spot, but they do have a loan maturity coming up.
Yeah. I mean, I haven't seen it enough to, I guess, get concerned and want to pinpoint, but why is a refinance not on the table? Both of the two properties that we've looked at where that's been the case, it's either been long-term ownership and they're ready to move on to something different, or it's a spot where they want to move into something different, and this specific location just doesn't really fit what they do. So that's a little bit at play. Fortunately, when people talk about maturities, and I think the way that our industry's viewed it, especially at like NMHC every year, you view maturities of, there's some people that screwed up on a business plan, they didn't hit their rents, and you think about all those people that did value add, went to a bridge loan, or they're heading into a refi and they're not getting what they want. These two properties, there's nothing wrong with it. They just didn't want to do a refinance, and they were willing to move on. So I think there's a little bit of that at play. To a degree, I think a little bit of it is what I mentioned earlier, of probably some sellers, some sellers understanding what's going on. And I don't know if that's sellers already coming to brokers with, hey, realistically, we know where this is at. If brokers have been able to kind of have more of an impact on seller expectations than maybe they were in previous years. But I just think, at this stage, I mean, this is the busiest January and February that I've had. Granted,
Because of deal flow?
Yeah.
Yeah. Much different from last year?
Much different from last year. I mean, 2023, I would say, is kind of, I don't want to say a throwout year, but there was stuff that was on market, and then
That's
was
what
like,
it kind of felt like.
yeah, stuff was on market, and then after that, it was, people don't want to sell, or they've just bought this and they need to hold on for a bit. So,
Are you worried that this could be another throwout year? I mean, again, if we're just so far away and there's like the fundamentals don't work relative to where sellers want to be. I mean, obviously we're going to do everything it takes to find something that works, but we said the same thing in 23. We were $10 million apart in 2023 though. I mean, that gap was wide.
Yeah. I think just because of the overwhelming odds we face on really any potential acquisition, it's not to say that I'm not worried, but there's a lot that I'm never really confident on. Just because it's like, there's always that attitude of, there could be a 1031 out there. There could be somebody with a lower cost of capital. So that's always at play, but I would say, in some ways I don't want to say like read the tea leaves, but, the fact that we've been this busy, the fact that when you talk to brokers, it's, I might have something, this group might be interested, or they're kind of hearing things. It seems to be that there's a lot more activity. I mean, we've offered more in these first 2 months than we have during the cycle in the past. So I'd say I find it hard to believe that this is going to be a dormant year, but we have a lot more traction in other areas than we have in the past.
Well,
And I would tend to think that that's a good thing.
I agree, and we're gonna find some deals. There's two questions. What are you seeing in the, I guess, value add, the older stuff? And I know there's a lot of interest in, call it, 2000s and newer, kind of core plus deals. We love buying that. We just tried to buy something like that, got outbid. There's been a lot of talk about who's going to be buying this older vintage product, 60s, 70s, 80s, even some 90s vintage stuff people don't want to touch. And it makes sense if it's priced like A-class. Like, I don't want to buy something that's built in the 70s, priced like it was built in 2023. But
Yeah.
but it's at a certain price, the cash flow's there. If it's priced accordingly, I think a lot of folks are. I think there's an unwinding of like the value add like trade, which was a trade of just passing deals back and forth or on to the next guy of doing 10 or 20 units, selling the dream to the next guy, and the next guy does a couple more units and selling the dream. There's this inflated idea of where rents can go with the same property, and so the cap rates were compressed down to like the 4 range, maybe even into the 3s, because there's this value add perspective idea that you could just push rents, force appreciation, get this big pop. Mm-hmm. But at some point, people pushed it too far, and those C-class assets were trading at a basis like near replacement cost of like Class A. And so now that's being kind of slowly unwound, and that's the stuff that like if it has been handed back to the bank, those are the types of assets that will be or have been. But are you seeing any? We've talked about there could be an opportunity in that space, because if there is no bid on those assets, there is a price where it does become attractive. Mm-hmm. We went after we've gone after a couple of 80s vintage deals in the last several weeks, kind of mid 80s. We were comfortable with that like a B class. It's built in like kind of not the early 80s, but the mid 80s that has minimal functional and physical obsolescence, thinking that maybe we might be able to find a deal. But no dice.
Yeah, so I think as a caveat to all of that, I think every broker out there, that does a lot of business and talks to a lot of groups, they know who's out there, and it's a limited amount of people that will touch anything in the 50s, 60s, or 70s. So they don't market that as much, because it's just like they know, like, unless you're built for that, and that's largely coming from like a CapEx standpoint. Yeah.
So a lot of those get floated directly. Is what you're saying? Some of them.
I think a lot of it is they're not. They know not to waste their time talking to, I guess, like a group like us, or some of the other groups that we frequently compete with on deals in town, where you've never done anything in the 60s or 70s vintage range. Then they know you're not going to start anytime soon. I think as for the 80s, that's becoming an interesting, kind of talking about patterns that we were looking at. There's a weird sort of market going on where there's value there because the buyer pool is diminished, but then you have to kind of look at, well, why is the buyer pool diminished? Yeah. You have some where if they're comprised of retail investors as their equity, those are likely retail investors that bought into those older value add deals in 21, 22. They've gotten burned via a rate jump, or in some cases, you've even seen deals where sadly they achieved the premiums, but then they stalled out because a bunch of new supply came on, and it really didn't matter.
Expenses or taxes or
and then on top of it, something that has also made that market a little weird is in 2021 and 2022, when bridge debt was an option. And you had some levers to pull where you could spend a lot of money revamping a property and still make returns work. You had a lot more people that were willing to be in that space. Whereas now, you look at properties in the 80s, as stuff that we've looked at, not only do we have to bring on money to do the value add work within the units to force some appreciation, A lot of them were looking at original windows.
Yeah.
So we're going to have to fix windows. And that's not something you're going to get a premium for.
You need to buy at a real discount to make all those repairs make sense. The amount of money that you have to put in a deal,
well, and bring on his
achieve a
equity.
premium. Yeah. And like we've looked at deals recently, right? That you would need the money that you need to put in the deal to do the work that needs to be done. To achieve the rent premium to even come close to justifying the purchase price.
Yeah.
When you move that rent, all of a sudden you are directly competing with Class A.
Mm-hmm.
I mean, we're looking at these deals in Indiana, north of us, and the great assets. Really liked them. Great, good locations. So seemingly, well maintained, and all they need is a light value add. They need some capital injection, but nothing's really broken. They just need to be kind of fixed up. Like our plan. They're like, let's get in here, but let's fix what's broken. Let's not slap things on just to get an additional premium. And one of the reasons is because the Class A comms, like right down the street, are like $250 more than what those apartments are currently charging. Mm-hmm. And so if we increase rents $200 to $250, we have the exact same rent as a brand new construction.
Yeah.
That is 45 years newer. Like, and so who's going to move into the 45-year-old property for the same rate with less amenities? No one would.
Right. And also, I mean, that's where it gets, and we talk about, absorption and some, multifamily sentiment and where things have positioned in, end of 25 and into 2026. You want to buy into that story, that stuff that's newer is going to take off. Mm-hmm. But then you also have to think, and if it doesn't?
Yeah. Well, let's move to that. And if you're worried that we're missing our jargon bin segment, fear not. We're gonna get to it. It's a good one, but I want to get through some of this multifamily stuff. You brought up absorption. Let's look at absorption. Again, this is just another data point highlighting how soft things are in the market right now. Multifamily absorption rate remains below 50%. This is the first time in the history since they have been taken in this survey of market absorption of new multifamily units, or SOMA data. This is the first time since they've been taking it that there's been 2 consecutive months, it's months, that are below 50. So we've had a reading of 47 2 months in a row. Now, we have had lower readings since it began in 2014. A couple months ago, it was at 42. And we've basically been hovering between 52 and 47, as low as 41, which was the lowest reading. And that took place back in 2024. I guess these have to be quarters. My mistake. Absorption is pretty low. Again, we had a peak when we were delivering a lot of supply. We have been still delivering supply, but compared to absorption when we were delivering a fraction of the supply pre-2020, we're just way off those levels. And when you're not getting as many people to move into new apartments, again, that's increasing the vacancy at those Class A deliveries, which is forcing them to lower their rents, and that scales down throughout the entire rental ecosystem from B class to C class. The reason why we're trying to buy the B class apartments in Indiana, and we're like, well, we want to fix it up and raise rents $200. You can't do that. Yeah. So for the renter, it's good. There's resistance in the ability to raise rents because there's so much competition. But so let me ask you this. So when you're underwriting, how do you write in growth? I mean, the whole concept here is private equity. We're going to buy something, we're going to try to run it a little more efficiently, and we're going to try to increase revenue by adding value, typically making the units look a little bit better. Mm-hmm. And there's often some organic rent growth that goes alongside that. If you're not growing, if your organic growth is 0 or less than the rate of inflation, you're losing money. So how do you underwrite in this environment?
Yeah, I think for stuff that's coming out now, most of which has, I guess, like higher than you would expect or higher than you would want vacancy while still being able to put agency debt on it. trying to have a better sense of, is it just kind of normal out of leasing season vacancy? They're going to get a couple leases and it's fine. What's the concession pattern? Why are they doing it? What exactly are the concessions, especially because that's what the lenders are going to look at and affects our proceeds moving forward. I think the biggest one that everybody needs to factor in when underwriting rent growth. I mean, yes, you're fine to slap the 3% or whatever percentage you want on there, but it's really the whole dollar amount. Because I think if you're underwriting the property and you look at where the comp set is, and then you look at what a 3% rent bump would be, if you're $150 behind the comps and you're then 3% rent growth for whatever you're at is only $40, you can be pretty confident, I would say, in underwriting that rent growth, just because you have to ask yourselves, based on where the comps are, where we're at, if we increase rents $40, how many people that are otherwise, not already thinking about moving into a house or weren't already thinking about moving, how many of them are going to see a $40 rent increase and say, I need to move somewhere else.
Yeah.
This is too much.
So, okay, let me unpack that a little bit. I heard a couple different things. One is that it's not all about percentages. More importantly, it's about the nominal dollar amount of rent that you're increasing.
Yeah.
So maybe not get always hung up on percentages. You just kind of baseline, regardless of what that assumption is. The next thing I heard is basically like nuance matters. And that each property has a different set of circumstances based on how have they been signing leases? Is it concessions? Is it highly concessed? Is it has a low concession rate? That adds a qualifier to the rent level that they're actually charging. And then, but also where it sits in the market. If it's naturally, if you look at the comps and it is naturally $50, $40, $50, $60 below where market is, saying that, if you increase that rent up to where market is, is that aggressive when organic rents are flat? Because you're really not moving it past kind of the organic market level. You're just moving it to market. Maybe it's more difficult to do that of any increases in a, like a soft market, but you can make the argument that you should at least be able to achieve where market is. And then, okay, well, how much is the market growing? And
Right.
So if market is growing by let's say just 2%, but the rents are 5% under market and you do a 5% increase, you're saying that's not inherently aggressive just because that's in excess of where the market growth is. Did I get
Yeah, and
that right?
I mean, kind of, it's why, to answer the very first question about the underwriting survey that you had displayed, it's why it's nice to kind of read those and see where the overall trends are and where people are moving. But at the same time, you kind of look at them with a lot of skepticism, because it's you want to look at the submarket, and I mean, you want to look at the market, submarket, as much information as you can. There's also plenty of times where it's really at the property level, and there's sometimes where it's very hard to look past how your property is going. Granted, it was a distressed sale, but I think of a property that we were looking at last year in Michigan where they had so many recurring concessions because they needed to get it leased up so that they can then sell it. That if you look at how many recurring concessions were going on, it was I don't care what the market's at. If I have everybody that's getting paid, they're paying, call it $2,000 a month in rent, they're getting $1,200 a month off on a concession. Not going to be able to push rents because I'm going to have a hard time getting them to just pay the full $2,000.
Yeah, well, so when that concession expires, that's a big swing.
Right.
Take the rent premium plus the concession. Then all of a sudden you're talking $200 plus, and that becomes much less palatable and might get someone to look for somewhere else to live.
Right. And so, looking at it not from the GP's perspective, but from the LP's perspective, it's okay, you can highlight the deal and say market rent growth. It wasn't that for the market, but market rent growth is 5%. You're looking at the deal level. It's I don't care if it's 5%. How are you even going to get them to maintain the level of rent that you're?
Yeah.
You're at?
How do you even maintain positive rent growth rather than get 2, 3, 4, 5%? What you're saying.
And then the other thing, going back when we were talking about the 80s deals, something
Yeah.
some of the older vintage deals that gets a little, I don't know if concerning is the right word, but it's something you have to factor in on the underwriting really is what is the current buyer appetite for it now? And have some ability to maybe try and anticipate what it's going to be moving forward. The 80s is really tricky because, you know, nobody's interested in it. But if enough groups realize nobody's interested, can you get cap rates to come down a little bit, and can those properties get bid up because everybody has that belief that there's not a lot of competition here? But then on top of it, it's hard to believe that if people aren't interested in it now, how many people are going to be interested in 5, 7, or 10 years? But also, if we now not quite a 2020, 2021 debt level, but if at any point bridge debt becomes more appetizing, all of a sudden your buyer pool could be a lot different for the better.
Yeah, if you can get a line of credit on the rehab. So I want to bookend this, but I think the kind of the silver lining this conversation is the frustration you may hear coming from Addison and I we're trying to win deals, trying to buy deals. Here's the reality, and it's really good for a portfolio, and it's really, I think, good for the market, or it could be, depending on how you view it. This is where we're at or near the trough, bottom of the market, no growth, war. We talk about a lot of shade to throw on, and there are bids on everything. There is investor demand, at least on the market. Now we're in the region in the Midwest that's working, so there's more attention that's being paid here. But there are bids. It's not like the market isn't getting a bid. The transaction volume, the volume of deals is increasing, and the bids are increasing also. Now, where does the bid and the ask, do they meet? They're not going to meet on every deal. Some they're going to be forced to because there's a maturity coming up.
Yeah.
But the reality is, the price floor that, we've talked about in the past seems like it's absolutely, intact. If anything, I think it bodes well for multifamily, for, the medium to long term, because there is that institutional shift. And also folks are looking for assets that make sense right now.
Yeah.
I mean, we're going to talk about some of the macro stuff and geopolitical. It's hard to make sense of the world and where we are. Where do you, there's chaos, but the S&P 500, the stock market isn't too far off the highs.
Yeah.
There's just nothing looks like a safe bet. Everyone's been dumping money in Nvidia and tech stocks, but even that's, really under threat right now for a lot of reasons, like we talked about on last week's episode.
Yeah.
If there's this kind of demand on the buy side and on the investment side, when rents are negative, things are slow, what happens when rents start picking up? And that might not happen this year, but when the market starts moving or really normalizing in the institutionalization of this asset class, because again, similar to some other asset classes that are out there, kind of private equity going into either retail investors or 401ks or wealth advisors saying, now you need to get allocated to these private assets like real estate. I think we're at the very early innings of that type of shift, kind of mixing in alternatives to public equities and bonds. But anyway, I want to move on. So we got to get into the jargon bin. It's been a very popular series we've been doing over the last, I don't know, month or two.
Yeah.
In every episode of the jargon bin, we break down a real estate concept, typically multifamily, 3 different levels. The first level is just very introductory. It's like explaining it like you're in 5th grade. We're going to make sure that you get at least the basic understanding. Then we're going to go one layer deeper, and that is kind of intermediate, where I think most investors, how they're thinking about it, kind of like what it really is. And then kind of the 3rd layer is how kind of professional investors think about it, kind of a little bit more nuanced, going deep and getting into some of the weeds a little bit. So Addison, you were going to be on. This deals with your world. And the topic of the jargon bin this week is stabilization. And so oftentimes, Griffin will ask me about the jargon bin question. I'm going to be asking you a little bit about the jargon bin question, stabilization, but I'll also add in here since I wrote a lot of this stuff up. Okay, so I'll start giving the definition, and then I'm going to bring you in. Okay, so in practical terms, when you hear, real estate investors say a property is stabilized, what does that mean? And that means the property is running normally and consistently, and it's producing income. It's very basic. So, practical terms, that's going to typically mean most units are occupied, the rents are at market levels, and operations are relatively stable. So, like if the apartment building was 60% occupied, that would not be stabilized. Maybe it was 90%, but the rents are, half of where market is. That would not be stabilized.
Mm-hmm.
The definition of stabilized would be like 95% occupied and the rents are right where market is. It's doing what it's supposed to be doing. For a very simple level, does that track? Not going any deeper, but is that the right way to think about a stabilized or stabilization?
Yeah, yes, I think, and I mean that's.
I'm gonna I'm gonna be like actively restraining you from going into more detail.
No, I was going to say that's I think why stabilization is a great jargon bin segment, or why it's a good topic or good term, because yes, it means that, and sadly, it also means other things.
It means that, but sometimes maybe not. Okay, so level 2, we're gonna add a little bit more detail to it. Not necessarily all of the nuance, but it's just a little bit more detail. So, okay, lenders, investors, how they typically define stabilized is above 90% or 90 to 95%. It also means that it's been stabilized for a period of time. So if you just like hit 90% one day, but you've been in the mid 80s, you're not necessarily stabilized. We want you to see some sustained progress and just sustained level of rents and occupancy to get there. Can't just be a flash in the pan. And ideally, you're seeing rents increase at like a relatively market pace. But it's not something that it's not stabilized as if you're in the middle of a lease up or if you're in the middle of a value add execution. You may be doing the things that you're supposed to be doing, and it's not that you could be following your business plan to a T and finding success, but you might not be stabilized. Does that make sense at this level?
Yeah.
All right, I just want to go deeper because then you can act because you're holding back, so we can actually have a conversation because this is where you live. You're the expert. Okay, deep institutional level explanation. Really, when I think of finance or when I think of stabilization, all I really think about is financing. And stabilized to me means it can be financed through traditional means, which when I say traditional means, I'm talking about agency financing. Can you put a Fannie Mae or Freddie Mac loan on it? And in order to do that, Fannie or Freddie need the property to be stabilized, which means they need to see it basically above 90% for a period of time. Now we can get into the nuance, but that's how if I'm thinking about stabilization, that's how I think of it. Can I finance this deal? Can I put a Fannie or Freddie agency loan on it, fixed rate, 7 to 10 year debt on it? What do you think?
I mean, yeah, I think like I said, stabilization means it can mean all of those things. So yes, I would agree. And also in this market right now, that's what we want to see. And quite frankly, if you guys somewhere bridges, we kind of need to see it. So
how else what does stabilization mean to you? How else do you see the term used? Because there are some other terms and uses, and just now you don't have any restrictions.
Yeah.
Talk about stabilization.
I would say by and large, I think stabilize the way that we look at it and stabilize the way the lender is going to look at it more often than not are similar. I think if Jay says something stabilized and the lenders that we work with say that something's stabilized, I know what they mean. The only other caveat and the only other thing that I've noticed that I think people need to be cognizant of is just, more and more as people are looking at stabilized yield, you then have to
tell us about that.
So stabilized yield is really more or less wanting to look at basically the yield, the income that you're going to get when the property is stabilized. And stabilized is in either, you're trying to get it up to 95%, or it could very well mean when you're at the end of your value add plan. And it's a result of kind of how much upside and how much income is going to be thrown off when you're done achieving what it is that you're trying to achieve.
So what you just threw out there is a big, it's nuanced, but it's a big change. What you basically said is you could be like in the middle of a value add plan. And so what you're referring to is like executing your business plan. And so I guess your relative stabilization shifts. So because again, your example, and you could be buying something that's distressed. That wouldn't be this example, but in this example, you buy something that's 90% occupied, maybe 91, stabilized. Rents have been stable, but your business plan is to fix up the units and increase rents $150, $200. So you're saying is your stabilized yield is your cash on cash return or like income yield that is produced after the renovations have been completed. You've increased rents in those units and you're achieving all of that new income that you're now able to charge because you've done the work.
Right.
Okay, so, but it was stabilized before. And so this is where like the nuance comes into place. You can be stabilized, but you can take it to a new stabilized yield, which essentially means you're executing your business plan.
Right.
It's going to take a couple of years to do. And that's now, but lenders aren't going to price your deal or underwrite your deal just based upon your stabilized yield. They'll take a look at it, right? But they're not going to like lend you on your stabilized yield.
Yeah, it'd be great if they would lend on what we think a property could go to.
I mean, I guess HUD kind of will. HUD will. They'll like look at your, the proceeds in like a year. If you close on a bridge loan, if it's like a bridge to HUD, sometimes HUD will take into account the value and they'll decide they're going to fund the increase. Over time. But
so, and I mean that's kind of the. We were talking a little bit, but before that's the what makes the term stabilized, fun in the sense that it means one thing to us, it can mean another thing to a lender. By and large, they're pretty similar, but then also you could have a property that you buy at 95%. But if you're doing a value add plan that's over 3 or 4 years, and could be heavy turns, but you could be maybe having some vacants that you could be. Maybe treating some of those rehabs as non-heavy turns, you can be stabilized in the way we look at it, but then you have to be stabilized at the end of year 4 and what that business plan looks like. But yeah, by and large, stabilized is largely meaning how we're looking at it and how the lender is looking at it.
I don't know. I have Creed's higher stuck in my head now, just thinking of like, the property might have stabilized rents, but you can take it higher. The business plan can take the property even higher.
Yeah.
Let's not play Creed right now. But thanks, Addison. That was a really good summary of stabilization. And again, a lot of these terms are terms you're going to hear thrown around all the time. And our intention is to kind of just break down that barrier, reduce the friction. And none of these terms are complicated. I tell people all the time, this is not a complicated business. Maybe there's moving parts, but it's all pretty straightforward. And the math rarely gets more complicated than like some division. That's about it. So
yeah, a lot of this jargon that's used in real estate and also in finance in general, I kind of want to know like at what point we decided to start using these terms and make it more than what it is.
Yeah, well, it's so we can exclude people. So someone pays somebody because you need to have us or someone here to be able to explain it. Okay, well, let's move on from the jargon bin and let's move into kind of the prime time. We've been at war now since last Saturday, Saturday before last. And now it's being called what was it? A special excursion? A short excursion, a short trip?
Yeah, short-term excursion, I think was
excursion.
Yeah.
I don't want to get into the whole have we declared war or not, and that's Congress's job or anything like that. But this is really getting down to what's important. And you could say this is a multifamily podcast. Why are we talking about the Middle East, the Persian Gulf? Well, it all is connected. Because we're talking about oil, we're talking about inflation, we're talking about potential recessions, a potential stagflationary environment that all impacts where multifamily is going to go. And again, I'm looking at this wall of maturities that it's taking place kind of halfway through this year, near the end of 2026. And a lot of these folks, some of them are in a good position. They've owned the property for a decade or plus, and they'll be able to refinance, so they'll be fine. But we have a lot of deals that are just razor thin on the margins, and they've been betting on rates coming down or rents picking up, a combination of at least one of them. We're looking at a situation where maybe neither of those things happen, and it might get even worse from an expense standpoint.
Mm-hmm.
We could even there is the recipe now for potential recession to take place. Oil at the beginning of this week hit $120 per barrel. We were kind of in the $60 to $70 range not too long ago. Now the prices have come down. I think they're like at $80, like right before we hit play. But we are at a situation of where there's another supply squeeze on the global economy, just like we saw back in COVID. Call it the Suez Canal getting stuck. All the COVID bottlenecks.
Yeah,
we're dealing with a squeeze of a commodity that is absolutely essential to how the world operates. We're talking about oil. We're talking about natural gas. And we're talking about the Strait of Hormuz, which 20% of oil and I believe natural gas flows through that strait. Not only that, but we're seeing a lot of the enrichment, extraction, and distribution facilities and infrastructure being taken out, both in Iran as well as the Gulf states. I'm going to go into that in a little bit more because from my intelligence, the reports that I'm receiving is that the destruction on the Gulf states is much more significant that's been reported. And we're looking at massive destruction of some of this oil infrastructure, as well as, massive production capacity on the Iranian side as well. And so even if we get the Strait of Hormuz opened tomorrow, which there's preliminary reports that an oil tanker was able to get through under escort of a U.S. Destroyer, even if the strait is opened, and Trump's saying now we want to take the strait essentially to be able to, hold it for whatever that means, getting the other side. Even if it's open, what's coming out of it? And how long does it take to rebuild this infrastructure? Because if we can't, we're looking at higher energy costs. We're looking at higher inflationary costs. We're looking at probably higher rates, certainly not lower rates. And we're looking at a consumer that is already pinched. Going into this satellite map, now this is a NASA satellite that tracks heat events. So it's originally designed to track forest fires. Been using it to track impact sites and strikes, and basically see what's on fire. And as you can see down here, there's certainly many sites in Iran. These oil distribution facilities, they're being hit. Bandar Abbas, obviously there's been a lot of activity over in this part of the Gulf, especially several days ago. Many of these facilities were hit. You can see these strike impacts here. There are fires. But what struck me, and I started noticing this really last week, is that while there was plenty of impacts and strikes all throughout Iran, as we would all anticipate, what really got me looking is all of these strikes that are taking place not in Iran but in Kuwait and Iraq. There was reports that production capacity in Iraq is down by 60 or down to 60%. Kuwait has been hit significantly. We look at whether it's Qatar, the UAE. We're looking at significant strikes on these oil facilities and oil distribution facilities. So again, I'm not an expert on the oil trade. I'm not an expert on a lot of this that we are specifically talking about, but I follow it pretty closely because I want to know where oil is going to go. I want to know where the interest rates are going to go. And I need to know if we're facing or looking at a potential recession. Again, these are not bonfires. This is oil infrastructure. Now, some of these are these flames that are for refineries. That some of that is true, but this is collaborated with reports on the ground of these installations being hit in a significant way, and just through the fog of war and a preference from this is just standard psychology. If you're at war, you're going to be talking about the things you're doing well. You're not going to be highlighting your damage assessment. Not, I'm obviously all for the U.S. Obviously, Iran sucks, but we got to look at from an economic perspective, what are the steps we need to do, and how do we prepare? So, based upon some of the research that we've put together, I mean, the recession probability has increased significantly. We're now looking at probably a recession rate, closer to around 60%. More likely than not, we could be facing a recession. Now, Trump signaled as early as yesterday that, hey, this is going to be, again, a short little excursion. We're going to be unwinding this. We're going to be getting this all wrapped up. Again, this tanker came through, so the markets are calming down a little bit. But again, can you put I think the genie's out of the bottle. And if Iran has no incentive to stop, the damage has been done. We've killed their supreme leader. So now their only choice from a game theory perspective is to inflict as much damage and pain on the United States and Israel as possible, so we don't do it again. They have to reestablish a level of deterrence. So even if Trump says we're all done, doesn't mean that Israel is going to be all done. Because Israel wants to push them back and make sure they can't do anything. They want to eliminate the threat to Iran by pushing over the regime potentially. Now Trump just wants it to stop. We want somebody we can deal with. Yeah. Well, that doesn't seem like that's going to be the case. So, Addison, you follow this. I'm concerned that we may be getting into we may be falling into a recession if things just absolutely don't pivot. Also, like, hey, if you think about it, it's like, oh, maybe we get some of this Venezuelan oil to offset things a little bit. But what's your assessment?
I think so. I guess kind of splitting it into two different ways. From I think kind of the business perspective, and where people are worried potentially with oil prices going up, how that can affect inflation. I've been curious about kind of this theory since we had the rate run in rates in 2022, where kind of as you mentioned earlier, we had issues with supply chains. Kind of having bottlenecks in areas, and our standard way of fighting inflation is to raise interest rates. And at that point, I think it was fair to ask, if we are having log jams at ports, and as you mentioned with the Suez Canal, how does raising interest rates solve that? How does interest rates fix that log jam? And in this particular instance, as we're talking about oil infrastructure being impacted and the supply of oil, being impacted, even if we were to raise interest rates, what does that do? And even if we were to drop interest rates, what does that do? It's not like it's going to change.
Is it going to kill demand? Yeah, because you raise interest rates to like reduce demand.
Right. So that's more or less where I'm curious, because if we start to have inflation issues, how's the Fed going to look at it? And are those questions even going to be asked? Because it seems like ever since Paul Volcker, we've largely resigned ourselves towards, hey, there's inflation.
Yeah.
Raise the interest rates.
Yeah. Well, but what about the dynamics of the Fed? Because we're looking at a new Fed, chairman. We're looking at, kind of a lame duck Fed chair, sort of, and our big policy changes, on Powell's, way out.
Right.
It's at a precarious time for the Federal Reserve to, consider, any major shifts to monetary policy.
Right.
Especially with the, the push and pull between the Fed and the Trump administration. What can they? Does this tie their hands and limit the options? And if we find ourselves in a recession, are we going to have all the options on the table?
I mean, I think for somebody like Powell, I get the sense that he's very proud of the institution that is the Fed. So I think for him to kind of toss his hands up and say, "What the hell? I'm leaving anyway," I don't think he could probably bring himself to that. I also think you have to get in that position being an extremely responsible and cautious individual. So I don't think he gives that up. Um, but I would have to think that the incoming Fed chair is going to have to look at it differently than uh, Jerome Powell would, in the sense that, I presumably want to keep this job for a while
Yeah.
and would want people to have a positive viewing of me beyond Donald Trump's administration. Um,
That's a interesting line to walk.
yeah.
Difficult line to walk.
Um,
Are you read up on Kevin Warsh at all?
I know he's a heir he married into the Estee Lauder family.
Okay,
I think.
I didn't know that.
Yeah,
Yeah.
I think he has some connection there. Um,
Youngest Fed governor, I think, of all time, I believe. I think he was like Fed governor when he was like 36 or something.
yeah, remember reading that, and I think when there were
38.
concerns about that, people like defended him, like, no, he's really that good.
Yeah.
But
He also was basically around 2006, 2007. He was one of the few that basically was pushing to not bail out the economy, to not be as accommodative, and to kind of let the recession happen to kind of flush the economy out. So almost a little bit more conservative and traditional, I guess, from that sense. Hawkish, as some would say, although he's very much open to lowering rates in the short term, at least prior to this whole situation, relative to AI productivity having an overly deflationary impact. But take that aside, just the reaction to crisis of saying, well, maybe the Fed needs to take a step back and not as an active role. How does that make you feel when we're staring down the barrel of whatever this might be?
I mean, I think I can't blame him. I think nobody knows where this is going to go and what this is going to delve into. But I think, where I am curious, and we've talked about it before, of how the Fed, what measures they use for inflation. I can totally understand wanting to take a cautious approach on rates when, now, granted, I don't think this is the case. I don't have the data to say whether I'm right or wrong on this, but based on your other measures of the consumer price index and other measures of inflation that you're looking at, if oil's the one that's having the largest spike or the only spike, I think it makes sense for reasons I kind of mentioned earlier, that it doesn't make sense to jump rates when really the problem is just supply of oil in a country that's not the United States.
Yeah. No, it's a good point.
As for just in general viewing and based on where we've been in history, I would advise any U.S. president against conflict in the Middle East. Usually does not go well. And in fact, at this point, about 23 years ago, we had another administration say that this was going to be a short excursion.
Don't know what you're talking about.
And it was not. So I be pretty cautious about getting into this. But I also think, I mean, I don't think he did this to try and win the midterms. I'm very curious to know what their viewpoint is on this, on the midterms. And I wouldn't be surprised if the administration really wasn't even thinking about that.
It seems like so much of the efforts have all been around the midterms, though, of positioning. It could go either way. I mean, it seems like this, and again, I don't want to necessarily get into just talking about the politics behind all of this. I mean, it seems like we were kind of followed Israel into this for the most part. They were Bibi was going to make this move, and at least like the narrative has been like, oh, we've got to go. They also said we've been planning on this for like months, so I don't know, what it is.
Right.
But yeah, I mean, I echo your sentiment. I mean, it's easy to start a war. It's not easy to end one, and we don't really have the money, and I'm really looking forward to hearing what the actual goals are besides like degrading their missile capacity. Like just like what's the end goal and what's in it for the United States. I think that's been like in America, make America great again, America first. Just like what are we getting out of this other than the only explanation is like, well, if you're getting rid of the regime, then you'd have a peace and prosperous Iran, and they're a friendly neighbor in the Middle East. But it seems like they're going to go even more hardline and dig their heels in if you don't wipe them all out. I don't know how you you do that without. I mean, you certainly can't do it without ground forces. And Iran's a big freaking country, guys. It's big.
Yeah, I mean, I also wonder how much, as you kind of said, how much they're doing to impact on the midterms. I almost get the sense that they're doing what they want and then figuring out how they can frame it for the midterms around that, as opposed to
Yeah.
we want to win the midterms and what do we have to do to create that policy push. But yeah, I don't know. This seems to go against a lot of what they campaigned on in terms of getting involved in stuff like this. So I don't know what the exit strategy is, nor am I sure there is one.
Well, one step at a time.
Mission accomplished is what I'm saying.
Everyone is begging for a mission accomplished moment right now. Everyone's just like, can we just go back and not? But again, what's been done has been done, and just hope just less, no more loss of life, and I hope the United States, kicks ass where necessary, but also we really are smart about what kind of conflicts that we get ourselves into, because war is hell, and it's really expensive, and we really can't afford it. And technically, we have to go to Congress. Again, I'm not trying to nitpick, but when you call it a war, if you say that we're at war and this is a war, well, technically, only Congress can declare war, and
Yeah.
there's got to be probably some authorization for funding, and it'll probably pass. But we've gone so far, and this is just, I'm only on a soapbox because I have a podcast, and what's the point of having a podcast for like 6 years and never able to talk about anything? You can talk about whatever I want to each week, but we really need to think about if we're going to start killing people in other countries, just like why. And we should just we should have a conversation as a country, being like, this is what we want to do. Like it's worth it to us to knock Iran out. We could have that conversation. We could have the debate. We should do it. If we're under imminent threat or attack, which we weren't, that's different. But that's not what happened. In the idea that's like, well, Israel is going to attack, so they were going to attack us. Well, we could have called our dog to heel and had Israel not attack Iran. Pretty easy. So they wouldn't have attacked Iran if we told them not to. But anyway.
Well, I mean, as people talk about history repeating itself, it's in the middle. Had just finished the book Nixon Land that chronicled his kind of rise, his initial fall after his vice presidency, and then getting the nomination in his first term. And when they were talking about Vietnam, framing Vietnam and how they were trying to understand public sentiment, they had this understanding that Americans weren't necessarily against Vietnam, but their biggest frustration with Vietnam was, we're not really winning it. We don't really know what the exit strategy is, and we just hate this angst of it's a war that we're not winning. We don't really know how we're going to win, what the clear end goal is, and it doesn't really seem like not really getting better. It's not always getting worse. And so I think now, when you kind of said what's the sentiment of the American people, I almost think when we hear the crowd say no more forever wars with Iraq or Afghanistan, is it that it's really an anti-war crowd, or it's just they got tired of Iraq and Afghanistan because, like Vietnam, we were just there. There wasn't really an end in sight, and it wasn't something like World War II where the goal is we just need them to surrender, and however they fix Germany afterwards is not really our problem because this is a threat that we've got to eliminate. Because it's almost like to hear a complete reversal of some of these things is just sort of like, okay, but is this an anti-war thing, or we just want to be done with Iraq and Afghanistan?
Yeah, it also has to do with who's in office.
And then I also know another non-starter, because this requires investing money in things that other people don't like. But I think situations like this, and I would have also hoped with the Russian-Ukraine war, would probably get people in this country on both sides to understand the more things we can have that don't have to run on oil and gas, the better. And that's not to say that everything needs to not run off those things, but the less that we need it, the better.
Well,
and a more diverse energy policy,
so
the
here's the catch-22. On one hand, yes. So like if we had more things that don't require like fossil fuels, if we're less reliant on fossil fuels, then we're less impacted. One of the reasons why this isn't going to impact us as much is because I mean, we are much less reliant on fossil fuels, but it's also because we produce more fossil fuels.
Yeah.
And because we produce our own fossil fuels, we're not as reliant on the foreign, fossil fuels to have to import. And the challenge is, we're going into, the whole energy conversation is like, the what creates the base load, and then what's like the surge, because like the renewables, specifically solar, not really wind, but like solar especially, like are perfect. And like if we can just all use solar, that would be great. But like the technology isn't there to only use solar right now.
Right.
And so you have to have like a base load coming from somewhere, which the best would be nuclear, but we got to convince everybody of that.
Right.
And so the next best is like natural gas, which is not as clean as nuclear, but it's a lot cleaner than, coal. And then the next thing after that is coal, or some sort of like clean coal, which nobody really likes. But sometimes, I'm very passionate about the environment, but some of these wants for not using certain types of fuel are a very privileged conversation.
Well, right, and I don't know, and that wasn't meant as a like we need to stop doing this in general, but like
no, I know you're not wrong. I'm just like the nuance of it is like that's where we need to go, but then it's like where are we today, I guess. And then if it's like okay, we're going to go to all solar, but you're going to have to pay more for your groceries and everything else. The average American is like I can't do that. How are they going to afford their apartment? So I have to tie it back to multifamily.
Right, but I think kind of on that investment part, like I think as a society that needs to be a push of how can we figure out a way to. I don't want to say it's easy to just say get it to a level where it's where we don't have to get it to a level where it's cheap. But I mean, like I think enough of these shocks, like we've got to diversify in some way. And I know that there's people that don't want that or they're not interested in spending the money, but like it's going to take investment in this.
Yeah.
And we can't get to the end goal without starting somewhere. But as with a lot of things in this country, the starting somewhere is like we're either not going to do it or we don't know where.
So I have an idea to solve all the energy crisis. You want to hear it?
Sure.
So we have the technology. We have the technology for nuclear reactors. We've had it for many decades. Obviously, we have nuclear energy, but the military predominantly uses nuclear reactors all the time. We put nuclear reactors in aircraft carriers. We put them in submarines. We've put them on ships. We've even had plans that put them in planes, and we've had zero issues of putting a nuclear reactor in a frickin' metal tube right next to people. We've been doing that for like 70 years now. So like the technology exists. There were reasons on like the civilian side of why we can't like build new nuclear like power generation facilities. It has nothing to do with like the technology. It's just regulatory and basically like will. And so like there's the civilian regulatory regime is so difficult. Could take a complete rewrite of the of all our laws and regulations, in which we could do some of that. But a workaround would be if again, I'm all about the private sector, like doing as much as possible. But I'm just also looking in if I could be autocrat of the United States, we could do anything we wanted. How to get the job done is the military essentially sets up these reactors in parallel. I also think because they're going to need their own data centers because obviously they're trying to steal Anthropic, Claude, they need to be running their own secure data centers.
Yeah.
You can essentially have the DoD operate these facilities that are generating power for their own data center usage, but also are selling power back to the grid. And they could produce, a significant amount of power using these small modular reactors or same designs that they're essentially producing. We built them up in like northern Indiana. Same reactors are going to aircraft carriers, submarines. You string them up in parallel, and you can essentially power large, essentially the large, parts of the country.
Yeah.
It's done by the military, so it's not just whatever civilian. You're bypassing civilian regulations because you're just working in the confines of the military. The DoD oversees it. Again, then they sell that power back to the grid, provide us an abundance of energy in the United States, reduce our costs, and then we don't have to build a single coal power plant ever again. We just build out solar.
Yeah.
Let's do it.
I'm on board.
Okay, well, we've got the plan. We figured it out. We've solved all the world's problems. we may have a recession coming up over the next couple months, but we're going to take it step by step. Where all this, I'm just going to circle all this back around to multifamily. With this wall of maturities, slow rents, and continued fear, this creates an opportunity where it's potential to acquire assets at a discount.
Yeah.
Been saying that for a long time. Multifamily in 3, 5, 10 years, I have no concerns about where rents are going in the direction of pricing. And so if we can buy at a discount relative to the market today, because of some fear and uncertainty, it could make 2026 one of the better buying opportunities that we've seen in a long time. What's going against us is that everyone else is trying to get into the market, and there is such a bid on multifamily as we've discussed.
Yeah.
And there's just still so much competition. So we're going to be out there every single day. And Addison is leading the charge of trying to figure out what is our next acquisition opportunity. And hopefully, we'll have you back on here very soon to talk about it.
Yeah.
Awesome. Okay. Anything else? Anything else on your mind? Anything else going on in the multifamily world before we wrap up? What's going on in Addison's life?
No, I mean, nothing super crazy beyond really the day to day. I think, it's easy to talk about how things look internally because we have that view. People listening, people outside don't. But I mean, we've been a lot more active in this period of, in terms of being close on offers than we've been in the past. So I think that's a good sign. Very much hope it continues as we get into the summer.
Yeah, likewise. All right, everyone. Make sure you like this video. If you enjoyed it, leave a comment or question and let us know. Guys, we talked about politics way too much. Let us know. Say you don't want to hear about politics, especially from a bunch of multifamily investors. Why should we have an opinion? Or if you're like, hey, we thought you guys had a halfway interesting take, we'd love to hear your feedback because I don't want to talk about stuff you don't want to hear us talk about. But what do you think? Are we going into a recession? Are we going to see oil spike up? Do you think some of this oil infrastructure is being underreported? Do you think I'm just overly concerned and it's just going to be completely fine? Let us know down below. And if you're an investor, are you looking to make investments, buy multifamily in 2026? Are you going to wait for some of these clouds to clear before pulling the trigger? Love to hear more. And then you got to subscribe to the channel to make sure you get updates when we launch our next videos. We're dropping videos all the time, individual jargon bin episodes and more. So we'll catch you on the next episode of The Great Report.